Welcome to Old Fashioned Finance, the podcast that mixes cocktails and high finance. I'm your host, Caleb Frankert, and I'm joined by my good friend and fellow money muddler, Jason Burnell.
Caleb, can a podcast about finance be entertaining?
Not without alcohol.
Well, all right, let's mix it up. Yeah.
Back to school, back to school.
To prove to Dad that I'm not a fool. Oh, back to school.
It's back to school day.
It is back to school day. Yeah, I mean, which is weird. My kids are like mostly homeschool because we're super weird, but that's the way it goes.
My kids are, and my wife, everyone's back to school.
Yeah,
so,
yeah. Did you celebrate?
After a whole summer of waking up and going, why am I awake?
I know. Gosh, I have a rule in my house. Like August comes, I'm like, I'm not being quiet anymore.
Everybody's up.
I don't give a crap.
If Dad's up, everybody's
That's
up.
right. So I'm making my breakfast and I'm leaving. And if I wake you up, I'm sorry.
Well, Jason, when you think of back to school, what do you think of? I think of fog delays.
Oh yeah, that's a good. And it's been foggy.
It has.
Yeah.
That's how you know it's time to go back to school.
Is, yeah. That's
and
a
we're
good
drinking
point.
a drink today called the Fog Cutter.
All right.
How cool.
Yeah, that makes sense. Now I'm like.
Now do you see why I snuck this in?
I do. Yeah. All I can think of is like the strobe light on the buses that go in the country. Yeah.
Yep.
So I mean, a lot of our listeners may not be from like
Ohio.
the Ohio land and the country,
the tri-state area.
Yeah, it's really it's pretty cool to see the fog like come out of the cornfields in the morning.
Yeah,
or like
kind of creepy.
It is kind of creepy. And it pretty much the whole month of September it's foggy.
Yeah, you know, it's funny because you think of like all the fog delays and then some days they end up getting canceled for fog.
Yeah.
And then they have a free day and it's
Basically,
beautiful out.
yeah.
You know, the teachers and they're already thinking, oh no, we're digging into our snow days. We don't want to have to make this up, you know. But yeah, I remember a couple of years. I think there was a year not long ago that the first day of school was canceled because of fog.
Yeah, that's messed up. You know, like everyone's anticipating. I think that's cruel, actually.
Yeah. Actually, and I'm not sure. Last year they might have opened with a 2-hour delay, which my wife is a teacher. For teachers is craziness.
Yeah, they don't
2-hour
like.
delays
They don't
just
like
throw
that.
everything off.
Exactly. And I mean, you know, I think like my son, who's like a senior this year, that was emotional. And Jamie had her little guy here who was his first day of preschool, and he was like not having it. And
this is the first day of my daughter's last year at her school.
Yeah.
They only go up to 5th grade.
Yeah.
That was a little emotional. I saw the picture that came up on my Amazon Fire Stick that, you know, 5 years ago, and it showed her first day there. And then I got a picture of her today, and it's like, oh boy.
You're like, okay, Amazon, stop doing that. You're playing into my emotions, dang it.
So here's to not a lot of fog delays and getting out of school on time when summer rolls around.
That's right.
Jason, we're also going to talk about finance today.
Yeah.
So last week was maybe a little bit academic. Could have been dry at times. Maybe we didn't have as much fun as we should have.
I don't know, man.
I mean, I have fun with that. We're going to have fun with this one, though. We're talking about, this is tax talk.
Yeah.
Capital gains versus ordinary income, to be
Welcome
specific.
to Tax Talk Radio.
We're going to cut through the fog when it comes to I don't know. That was bad.
Does your tax situation seem foggy?
There you go. Boy, you've done this before.
Oh, gosh.
Well, let's get into
Those
the
were
drink,
all of our
Jason.
bad podcast ideas.
We have good ones?
Good
right.
point. Let's drink, man.
Yeah, let's get into the
We
fog
haven't even
cutter.
drank yet.
So this one has a lot of stuff.
Yes.
So much that I didn't even write it on our big dry erase board here. Jason, the fog cutter. This is actually, I don't think they, like many prohibition-ish era drinks, they don't really know where it came from, but kind of came back into popularity in the 40s. I know we don't do a ton of history on these anymore, but there's a reason. I'll get into just a little bit about the 1940s and where this kind of made a big comeback, which was in an Oakland, California bar, Trader Vic's, operated by Vic Bergeron. And,
related to Tom Bergeron?
Probably, I'm guessing.
Interesting.
This cocktail is not for the faint of heart. And in fact, this bar where they served this drink, where it made its comeback, there was a strict 2-drink limit, and you're done. You're done.
I get it. This cocktail is as simple as our tax code.
Man, this is just the perfect cocktail
my
for
goodness.
this.
There
We
are
haven't had any of
48
it.
cocktail ingredients.
This is very Long Island iced tea-ish.
It is. It's all liquor.
Let's get into the ingredients.
There's some juice in there.
There's some juice in there. Citrus. Yeah, this would be like a tiki drink. I think it falls in that category.
Okay.
So we start with 1.5 ounces of white rum.
Okay, check.
An ounce of cognac. A half an ounce of dry gin.
Okay.
2 ounces of lemon juice, freshly squeezed.
Oh, bummer.
1 ounce of orange juice, freshly squeezed.
Ooh.
A half ounce of orgeat. That's that syrup that we use for Mai Tais.
I'm excited about that part.
It's a good one. And then a half ounce of dry sherry.
Okay.
Interesting.
Yeah.
And you're supposed to float that on top. Mix all the other stuff together. Float that half ounce on top so it's pretty. And then you garnish it with a mint sprig. Jason, there's a lot of stuff in here.
Yeah.
Let's dig in.
All right, let's try it.
Cheers. Didn't want to break the glass there.
Exactly. It's a tall glass. We're not used to it. Huh.
What is that?
Oh, man, that is dangerous.
Mm-hmm.
You could drink 12 of these and not know you did it.
Oh, man. Strict 2-drink limit. So very lemony, but it's not super sour like last drink's drink was with just that. Remember we had like a half an ounce?
Yeah.
And it overpowered it. This isn't overpowering. Maybe the orange juice mellows it out a little bit.
Yeah.
But there's almost like a carbonated kind of thing going on here.
Is that the gin, maybe?
Maybe it is the gin.
No, well, we put sherry in there, too.
Well, that's just a dry wine, though.
Yeah, that's true.
I'll bet it's the gin. Because gin has that kind of piney, prickly kind of taste sometimes.
It does.
This is this is interesting. Better than a Long Island iced tea. I'll put it that way.
Definitely. You know what? I guess I don't usually say this. I wish this had just a little bit of sweet.
Yeah. There's maybe some simple syrup or something.
Yeah, maybe. Huh.
I forget what orgeat tastes like on its own.
Well, it's like almost like a coconutty kind of smell.
Yeah.
I don't know.
There is some sweetness there, but
it could be a little sweeter, just a little bit. Like I feel like a dash of simple syrup. I mean, it needs a little
bit of simple
ingredients.
Syrup. Yeah, just throw some more ingredients in. Let's put it this way. Is this cutting through the fog? I think this might be inducing a fog.
Because it's dangerous.
Yeah.
I mean, I can't hardly taste any alcohol. I mean, I get the sherry more than anything.
Yeah. That dry bite a little bit.
Huh.
I like it.
Orgeat is
it made from almonds?
Yeah.
There's a big almond on the bottle. That's why.
Yeah. I mean, but the first ingredient in orgeat is sugar.
Okay. So there's your simple syrup-ish.
Yeah. So maybe
canceled out by the lemon.
Maybe
the
putting
citrus.
a little bit more orgeat in there might be.
Okay.
I'm going to try it. I'm just going to.
What's the worst that could happen?
Yeah. I mean, I like it more. Just a little dash in there. I'm going to. Yeah. Just a little more sweet. That's good. That actually, I like that.
Yeah, on a really hot day,
that is a hot day kind of drink. So maybe not appropriate.
We're running out of those
for back to school.
No, the first month was always hot. Remember, we didn't have air conditioning.
Oh yeah, that's right. Gosh, like I mean, if you didn't have air conditioning in your school, you remember that feeling of peeling your legs off the seats.
Ugh.
Like, yeah, oh my!
You didn't want to
God.
wear light colored pants.
And when you sit in the chair in your next class and it's wet, oh gosh. Yeah.
Or you had gym first period.
Oh, man.
And nobody showered.
Oh, nobody showered.
Because it was a big open.
Yeah, we just talked about that today.
Oh, man.
Oh, well, anyway.
Back to school. Okay.
Yeah.
Well, you know what? Back to finance.
All right.
Let's talk about tax stuff.
Yeah.
Taxes.
As interesting as first period geometry.
Oh, no. This is way more interesting for me.
I agree.
So we're going to go into some detail today on capital gains and ordinary income, what that means for you out there.
This is confusing for folks.
It's very confusing. And when in doubt, I always go back and check. And then we're going to actually take a little bit deeper of a dive, and we're going to we're going to dive into the brackets and all that kind of fun stuff.
Oh my gosh.
We're going to talk about what it means for an individual taxpayer, whether they're single or married filing jointly. And we're going to even delve into trust and estate waters.
Oh my.
Because it's important, and darn it, it's practical for you listening to this show.
And doggone it, people like
me. And doggone it. I'm good enough. I'm smart enough. Stuart Smalley, right?
That's right.
Is that his name?
Yeah. Something like that.
And gosh darn it, people like me.
I said doggone. It's okay.
But this is insanely practical for the average listener, I would say, because trusts, as we've talked about before, are not all that uncommon.
Yeah.
And this is one of those issues where we might take a look and say, is a trust really necessary? Well, let's look at the taxation.
Yeah, and usually ends up coming up when it's like, why did I pay so much in taxes, dang it?
Yeah, exactly. So let's start defining what we're talking about here today. Ordinary income, Jason. So kind of like it sounds, everyday income, right? So let's talk about what falls into this category. This would be wages, so your salary, tips,
Yep.
interest on bank accounts.
Yeah.
If that's a
you got to
thing.
claim that 0.06 cents.
Right. As long as it's over $10.
Point depressing.
So interest, dividends, unless they're qualified dividends. I'm going to qualify that with a qualification. Unless they're qualified dividends. That's not the scope of this episode.
No, it's
we can
not.
get into that another time.
But dividends count.
Dividends. And then again, practically speaking, IRA distributions. Right? You're retired. You're going to start living off of your nest egg.
Yep.
That's ordinary income. Short-term capital gains. If I'm going to add some fog to the mix here that we can cut into later, short-term capital gains are taxed as ordinary income.
Yeah.
We'll get into that a little bit more when we talk about what capital gains are.
Oh gosh.
And then, another one would be, I didn't write this down, but think of annuity withdrawals.
Yeah. Yep.
Interest on annuities.
Yep. Absolutely.
So lots of things fall under this ordinary income umbrella.
Whether you have a retirement annuity or a retirement qualified annuity or a non-qualified annuity, it makes a difference. So
if something's coming out of an annuity one way or the other,
there's some taxes happening.
Bingo. And it's going to be ordinary income, which is also not the scope of this episode, but why deferred annuities can be so dangerous.
Tax time bombs.
Yep.
Yes.
All right. So I think you got an idea there of ordinary income. Basically, if you worked for it, it's ordinary income. And then dividends, interest, that kind of stuff.
Yeah.
And again, IRA distributions, well, you worked for it at some point. You just haven't paid taxes yet. When it comes out, it's taxed as if you earned it that year.
Uncle Sam's going to be standing there with his hand out.
Yep. Let's talk about the brackets a little bit.
Oh, my gosh.
So ordinary income brackets, Jason.
You're creating fog, I think.
So this is 2022.
Okay.
These numbers change a little bit every year.
This is important to just look at these charts.
Yeah, absolutely. And you know what? If you're a client or you are a listener and you want these handy dandy charts, let us know. Blue Jay prints one up every year that has all these important tax numbers that are darn handy. Really good cheat sheet because we don't have the tax code memorized.
Great bathroom
here, by the way.
Great bathroom
absolutely.
Reading. Yeah.
So
this episode is brought to you by Blue Jay Tax Charts. That's bluejaytaxcharts.com.
Don't go there. And maybe it does. So let's talk about our ordinary income tax brackets. If you're single, $0 to $10,275 is taxed at the 10% rate. Married filing jointly, $0 to $20,550. Now, I'm not going to go through all of the brackets, right? But for reference, we jump up into the 12% bracket for a single individual. $10,275 to $41,775. Married filing jointly from $20,550 to $83,550. The next jump, and this is where this gets really insanely practical, I think, is the 22% tax bracket. So at a single level, $41,775 to $89,075. For married filing jointly, $83,550 to $178,150. Pretty big range there.
Yeah.
And then the next step up only goes up to 24%. So the focus, I think, when we look at capital gains, ordinary income, we're honing in on these brackets here. The jump from the not necessarily the 10 to 12% bracket, right? But the 12 to 22% bracket. That's a pretty big hit.
Yep.
Okay. So if you're in that range solidly, and let's say you take money out of a deferred annuity, you could pretty quickly pump yourself up into the next bracket, and now you're paying 10% more on all your withdrawals and every other bit of ordinary income that comes in beyond that.
That's right. I think the moral of the story here is you just need to understand your income. Like if you're doing something from a financial perspective,
don't wait until tax time to figure it out.
Stop and take a minute and be like, hey, okay, how is this going to impact my income number? Is it going to be, capital gains or income? And, that's why people that are nerds like Caleb, who are EAs, exist. They're there to help you through this.
Yeah, so this is pretty alarming when you jump over to the trust and estate tax brackets.
Yeah.
So that 10% range is $0 to $2,750. That's not a lot of income. Dollars, right?
Yes.
Then we jump to 24%,
right.
Jason, at $2,751 up to $9,850.
Which is not even that big of a range.
No. And then we jump all the way up to 35% at $9,851 to $13,450.
Also not a big range.
No. And beyond $13,450, 37%.
You know what I have found? I have found every client who has a trust just loves giving 1/3 of it to the government.
To compare, Jason, to hit 37% on the individual side, that's a couple with over $647,000.
So you're talking like they're exceptional income levels at that point.
Versus $13,000 income for a trust.
Correct.
Right?
So Now, in a trust, like a trust doesn't go out and have a job, and they don't.
But they can generate income.
Okay, so how is that done? Like they're generating dividends, right?
Yeah,
mostly. I mean, maybe it's passive income of some sort, which is a whole nother topic.
But they can also generate income in the form of like rental properties,
sure,
things like that.
Right.
So it doesn't take a lot to get pushed into that highest bracket.
That's correct.
So we're setting the stage here. All right.
Yes.
So if you're listening, chew on this for a little bit. Okay. We're going to move on to capital gains now and talk a little bit about what capital gains are, Jason. So I have kind of just written down here. It's gains on investments, right? You buy a mutual fund for $10,000. You sell it a few years later for $15,000. Your capital gain is $5,000, right?
Right.
Because the money that went in was already taxed. So we're talking about, that's not ordinary income.
Right.
That's a capital gain. To make it a capital gain, it's got to be held for a year or more, right?
Correct. Yep.
This is where I'm going to go back and say short-term capital gains are taxed as ordinary income. So let's say you decided that the market...
fund.
Yeah, same mutual fund. You thought the market had hit the bottom back in June, and you've run up another 17%, and you go, you know what? Let's cash out on this. You're going to pay basically ordinary income on that because you didn't hold it long term.
It's going to impact your regular income.
Your regular
tax bracket.
income.
It gets added to the bucket.
Every bit of wages, tips, interest, dividends, annuity distributions, right? Every bit of it beyond that point, it's going to affect.
So the way that I would phrase that is, good job, man. You did a great job, and you're evil and you should be punished.
Yeah, well, yeah. Again, not the scope of this episode.
Oh,
but,
that's okay. Sorry.
So gains
just try to keep it light.
Gains on investments, real property, so like rental properties and things like that. Now, again, I keep saying this, not the scope of this episode, a personal residence. There's some ways to get out of this.
We don't need to get in that.
But business assets or even a business, right? Somebody sells their small business. There's a cost basis.
Correct.
Right? And then there's a capital gain.
Correct.
All right. So we talked about short-term versus long-term a little bit. And the big thing we're looking at is cost basis. That's where what you started that investment with, when you sold, how much you made, that's going to determine, what your capital gain is and how you're taxed. Right. Let's talk about tax brackets for capital gains. Ooh. Okay. So let's see here. Let me make sure I've got my right. Oh. All right. Long-term. Yes. Long-term capital gains for 2022. All right. Here are the brackets. Okay. So for a single person, up to $41,675 of income.
Of 0% capital gain, right? Is this a capital of other income? I got
right.
it. Yes.
This is where you're going to fall in that 0%.
Zero.
Right. So for a married couple, darn near $84,000.
Yeah. So
from a tax planning standpoint, by the way, capital gains can be really advantageous.
Right. For it.
Settling on your capital gains, right?
Yeah. So I think that people get really upset, when they start looking at capital gains, especially in like their investment accounts. And I would say that there's many times after they look at their, adjusted gross income,
right,
that they don't owe it.
Yeah, you might be worried about making a shift in the portfolio or taking money out for a furnace or whatever. And we get to look at the taxes and we say, hey, here's the deal. You've got, $20,000 in capital gains here to settle up on, but because of where your income lands, you're in the 0% capital gains tax bracket, right?
Yep.
Beats the heck out of, am I in the 12 or the 22 or 24% bracket?
Exactly. And so like this is one of the reasons we advocate so strongly for our clients to bring us their taxes.
Yeah. One of the many reasons.
Yeah, and because we don't know what we can't see.
Right. So, tax planning is super, super important, obviously, when we're in distribution phase. But even like these one-offs, like, something came up and I had a big event where I had to fork over $50,000. Where do I pull from, right?
Right, exactly.
So capital gains are treated very favorably as of now under the tax code. Jumping back into these brackets, for a single individual from $41,675 all the way up to $459,750, 15%.
Oof.
Okay, so again, in comparison to ordinary income brackets, right? We're pushing the highest bracket there. We are in the highest bracket for an individual there. For a married couple, it's $83,350 up to $517,200. At 15%, right? You want to settle up on capital gains versus ordinary income, definitely. And then above those numbers, so for an individual over $459,750, it's 20%.
Right.
Up into infinity. And for a married couple over $517,200, again, up into infinity, 20%. So as of now, 20% is the worst case scenario.
Yeah.
Now,
and I mean, again, like I think that a lot of folks might be more familiar with like the Warren Buffett example that always gets thrown out there, that Warren Buffett has a higher or lower tax bracket than his secretary. Like that's one. I think that's one that's especially during periods where the market's not that great. And it actually might be true, but Warren Buffett's income, he pays way, way, way more in taxes. Okay. But most of his earnings are from capital gains. He's investing in companies, he's selling, he's making a profit, and he pays those brackets versus the income tax brackets that go all the way up to 39%, right? And his secretary earns a wage. At least I bet she doesn't. I'm going to bet you. But I bet she has a tax bracket that might be 22, 24%. And as a result, she's paying more in tax bracket as a percentage. But that doesn't mean her income, it's nowhere near what Warren Buffett's is on an annual basis. So I think it's important to, kind of look at some of that rhetoric and make sure, you understand how they're spinning the story when it comes to what people are paying capital gains versus ordinary income.
Yeah. So in most cases, unless you're making really piddly amounts of money, capital gains is a much more favorable way to be taxed, which also flips us back over to the trust side of things. It's much more favorable for a trust to be taxed on capital gains than ordinary income.
That is also true. Yes.
So where does all of this stuff fit in, Jason? We don't try to be, I don't want to say we don't try to be tax gurus, because we kind of are, and we definitely give tax advice. But we're looking at ways to employ these strategies when it comes to everyday things for our clients. How can we improve your situation from a tax standpoint? Well, there's some strategies we can employ, right? So when does this practically come up? Well, it might influence your decision on whether a trust makes sense or not.
Definitely. Especially just arbitrarily throwing your assets in there and thinking that you're getting
because
some
an attorney told you so.
Yeah.
Right?
Yeah. You went and got a free dinner at the Holiday Inn Express and you think that it's a good idea. And
And we did this. We did a you don't need a trust episode way back. And but a lot of times it's I want basically to know who my assets go to when I die. Well, you can do that with simple beneficiary instructions in most cases. Now, we had a case last week where we had a referral from a local attorney here where a trust definitely was in order.
Probably the only way of getting it done.
Absolutely the only way of getting it done. And, in this application, I guess we're looking at growth long-term to later pay out a beneficiary.
Right.
So in the meantime, we don't want a bunch of dividends. We don't want a bunch of ordinary income.
Right.
We want capital gains. So that changes the way that we invest things for sure. We're not looking for income producing assets. We're looking for growth oriented assets.
Yeah. So like the practicality of that is, make sure your advisor is, focused on this.
Absolutely.
Okay. It may or may not impact you. Okay. So I think a good solid tax strategy is important for every person that's out there making decisions on, how to invest, and what their advisor is doing is really important.
If your advisor and your tax person can talk,
even better,
and they're on the same page, no surprises at tax time, which is what we want. So thinking of strategies that we can employ here, I think the most practical thing, Jason, we kind of touched on whether trust makes sense or not. That's one area.
Yeah.
But just really basically on an everyday basis, structuring withdrawals in retirement, right?
Yeah.
We've got clients who have a lot of IRA money, right? Mm-hmm. Everything that comes out of that's going to be taxed as ordinary income, but maybe they've got substantial assets in non-qualified accounts too, and they need more income, or furnace goes out, roof needs repaired, whatever. Where are we pulling money from? Well, okay, here's an opportunity where if we've been rebalancing along the way and settling up on capital gains and things of that nature, we may be able to sell assets and even take a tax loss technically on a non-qualified account.
Right.
Or if we're looking at, we're in a high income tax bracket, do we want to take our capital gains versus pulling more from the IRA? Those types of things. So really how we structure everyday income for our clients. And I say especially those one-off situations, which are never one-off. They happen more often, right? Like, oh, I know I'm calling because I need money again, and here's what happened. A lot of times the answer is, yeah, I can get that money out to you right away. But give me a couple of days to digest this and run through your tax situation, and let's take a look at where we want to pull from to see where is the most beneficial. And there are some years where taking it from the IRA actually makes more sense.
Yeah, and so, for me, I think having options for a client, to go through and have a bucketed approach where there's money that's, tax qualified, after tax. It's important to be able to pick from, not just one bucket. It's not just an IRA, or it's not just a Roth. It gives us the ability, especially during, the structured income scenario, retirement or encore career, to be able to design it from a tax perspective, I mean, it's just so important.
Yeah.
And you hit the nail on the head with all that nerdy stuff you were saying earlier with the brackets. We're talking tens of thousands of dollar impact. I mean, this isn't small numbers. And again, a good solid strategy will help us get through that and navigate. And we won't always be right, exactly right, because a lot of times this is happening.
Yeah.
You got to be careful not to just be focused hindsight, looking back at what happened the year before, because this year is different.
It's always different.
Yeah. Last year was a great year in the market. We had cap gains. This year, it's going to be the opposite.
This year,
probably.
we're looking at taking some losses. To actually offset some of the other gains that we might have.
That's right.
That's the next strategy too, really, offsetting gains and losses. That's something that your advisor and your tax person hopefully are looking at every year.
Absolutely.
That's part of just good old-fashioned financial planning that, in my opinion, most advisors look past this, or they say, hey, I'm not qualified to give that kind of advice, so I'm not going to.
And really, in their defense a little bit, I mean, they just may not even have the tools that allow them to see it.
Yeah.
And
exactly.
Yeah. So I mean, it's one of those things that if you're dabbling in this realm, you just need awareness. Let's just put it that way.
So the last thing that I'll kind of comment on is not just income that you're going to take over your lifetime, but think about passing assets on. Right?
Yeah.
So, Jason, from a inheriting assets point of view, if you think about it this way, if you're invested in things like stocks and mutual funds that create long-term capital gains, there still is a stepped up cost basis at death for non-qualified assets, right? And that's huge. I would rather inherit something with a stepped up cost basis than get a big fat traditional IRA, which is all going to be taxed at ordinary income, right?
Yep.
Or a big fat deferred annuity that's got a bunch of ordinary income built up in it.
That's going to impact your whole income tax
every dollar that you earn above and beyond. Exactly.
Right. Exactly. So, the best, my preference is I want to inherit a Roth IRA.
A Roth IRA, sure.
Okay. So, it's tax-free. It's been growing tax-free. You can stay in there 10 years. Like there's lots of benefits to having that money pass through. And that's why we're such huge advocates for, looking at Roth conversions, things like that. And depending on your brackets, it may make a ton of sense. So,
well, Jason, this was a taxing episode.
But don't think
that was so bad. I hope they cut that.
It was. Hopefully, you're not foggy.
I actually had a lot of fun.
I know.
Here we go. I had fun
nerds.
in this
We're
one.
nerds. I mean, I think honestly, let's just get down. The brass tacks of this is you got to look at this.
Yeah, and the more eyes, the better.
Right.
Have your financial advisor, your tax guy or gal, whoever on the same
inquisitiveness,
page. Right.
Oh.
Do your research before taking withdrawals.
That's
sure.
right. Exactly.
All right. Well, thanks for having a drink with us this week, folks. It's time to close out the tab. If you have a question or a topic you want addressed on the Old Fashioned Finance podcast, be sure to email us at podcast@bluejfg.com. We'd love to hear from you. Don't forget to share the show with someone you love or just someone who needs a little money muddling themselves. You can stay up to date with the latest action by following us on Facebook. Old Fashioned Finance is brought to you by Blue Jay Financial Group. That's bluejfg.com, and produced by Podastery Studios. We've been your hosts, Caleb and Jason.
Cheers.
Blue Jay Financial Group, LLC. Blue Jay is a registered investment advisor registered with the state of Ohio. Registration does not imply a certain level of skill or training. The presence of this advertisement on this podcast shall not be directly or indirectly interpreted as a solicitation of investment advisory services to persons of another jurisdiction unless otherwise permitted by statute. Follow-up or individualized responses to a consumer in a particular state by Blue Jay and the rendering of personalized investment advice for compensation shall not be made without first complying with jurisdiction requirements or pursuant an applicable state exemption. All verbal and written consent on this presentation is for information purposes only. Opinions expressed herein are solely those of Blue Jay unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.
Yeah, I'm actually having bourbon withdrawal after this one. I'm not going to lie. So,
well, we can fix that.
Yeah.